Are you saving for retirement with an IRA, 401k, 403b, or 457 account? Do you realize that income taxes, investment losses, and management fees will reduce your retirement income by at least 40 to 50%? Yes, that is correct, by 40 or 50%, and not maybe, but definitely. Let's begin with taxes, because the money we deposit into any tax-deductible account and the growth on that money is only tax-deferred. It is not tax-exempt. So all of that money is taxable and at rates that are likely to be considerably higher when we retire. But even if they are not higher, we will still pay much more in taxes on our retirement income than we get to deduct on our retirement savings. For example, if we save $500 a month for 30 years, that's a total of $180,000. And if our money were to grow at the rate of 7% a year, that would amount to $606,000, which would allow us to withdraw almost $46,000 a year from principal and earnings over the next 30 years. That's a total of $1,380,000. So, we get a tax deduction on $180,000 over the first 30 years, but we pay taxes on $1,380,000 over the next 30 years. We're simply trading a small tax deduction for a much larger tax liability. Wouldn't it make more sense to pay the tax on the $180,000 and take the $1,380,000 tax-free? Now let's consider investment losses, because most of us have our retirement account savings invested in the stock market. And while we can grow our money in the stock market, we can also lose our money in the stock market. In fact, according to data tracked and compiled by Yahoo Finance, over the 20-year period between 2000 and 2020, despite an extraordinary and unprecedented period of growth in the stock market, the S&P 500 stock market index actually lost value in 1 out of every 4 years, losing 9.11% in 2000, 11.98% in 2001, 22.27% in 2002, 37.22% in 2008, and 4.41% in 2018. And it's not just the money we lose, but the time we lose as well. For example, when the market loses 30 or 40% of its value, as it did between 2001 and 2003, and again in 2008, we need to earn a compound annual growth rate of at least 10% over the next 5 years just to recover our losses and get even again. That's 5 years at an average compounded rate of 10% a year just to get back the money we lost. And if your income is dependent on your investment earnings, think of how those market losses would affect your retirement years. What's more, these conventional retirement savings accounts typically charge us fund management and plan administration fees that can range from as little as 1% to as much as 2% or even 3%. But these are not simple one-time charges on each deposit into our accounts. These fees are a percentage of our entire account value, deducted every year, even when our accounts lose money. And while fees of 2 or 3% might not seem like much, these recurring annual deductions are actually very costly, because every 1% we pay on our account balance every year over 20 or 30 years will leave us with 20 or 30% less money at retirement, which means that a 2% annual expense charge over 20 or 30 years would leave us with 40 to 60% less income during retirement. However, there are 2 alternatives to conventional retirement savings accounts that will eliminate income taxes, investment losses, and account fees. One, provided by Internal Revenue Code Sections 219 and 408, and another provided by Code Sections 101, 72, and 7702.